Myth number 2 is you can't get your money back. You put $1 in and you can't get it back for 10 years. Let's bust that myth.
I get a question from advisors as well about how the tax credit comes.
Titled insurance bonds or investment bonds. We don't know what to call them. We're confused. And so we've embarked on getting some specialists in to tell us which one is it and which one is it not. So Jarrad Gray's here from KeyInvest in South Australia to share a little bit about his journey to where he is today, which is always interesting, and then start to bust some myths, Jarrad, in terms of what the hell do we call this, and what are some of the still things that advisors have in their head around investment bonds that they're not fully across, perhaps that they're expensive, maybe one of those past things. And so we're going to dive into a little bit of the history of these structures, just so we all understand them. And then obviously some case studies of where we're actually seeing them being used in the market at the moment. And believe it or not, we'll touch on the tax changes and be able to somewhat have a discussion around where these structures might actually be beneficial in the future based on the superannuation rules that are law, as well as the theoretical changes that are coming down the line as well, which we haven't seen all the legislation for. So that was my attempt at the detailed Craig Kamanis introduction. I know that you will be missing Craig today, but Jarrad is filling his big shoes and obviously representing South Australia at the same time. So Jarrad, welcome, and let's hear it from you.
Thank you. Thank you for having me on today. And yeah, it's great to be with you. Unfortunately, Craig can't join us. I've known Craig a really long time. In fact, back when he was with, I think, Securitor a long time ago. Craig's a well-known compatriot of the South Australian financial services industry. And
even smaller than Sydney.
Yeah, exactly. Yeah. So yeah, it's a shame he can't be on, and he would love the topic today. He's a man of detail and intrigue, so he probably would love this session. So hopefully it's recorded. I can make sure that I pass it on to him later. But yeah, look, it's a heady time for investment bonds, and I'm already alluding to probably some of what the original question was about. What do we call these things that have been around a really long time? But old is new again. It's like Paisley shirts or whatnot. Old is new. But yeah, would love to give a bit of background to where I've come from. I've been in the industry sort of 25 plus years. I don't look it, but I started out as an advisor. I did that for nearly 8 years. I moved interstate and worked in some interesting tax effective product structures, a retail insurance arm in Astron, which doesn't exist anymore in its old form. And then finally in practice management with a big bank owned AFSL before a little bit of time in fintech, which gave me a really nice little inroad into technology and how that works, and finally landed here at KeyInvest. I thought what I'd do is talk a little bit about the backstory. So I find today a lot of advisors don't really know where these things came from, apart from some that have dealt with them. So usually they've been around in the industry 30 plus years themselves. But basically these things evolved in the 1800s, believe it or not, before the Federation of Australia. They're really old. Essentially, they were the super before super came along. And there was a couple of reasons for that. There was a massive exposure in the market for people around the death of a breadwinner. Illness or disability was really quite crippling for people. People struggled with funerary costs when that happened. There was a lot of retirement poverty, as they called it, or just medical expenses when people needed care. And so obviously these things evolved before there was any of these welfare systems that we now appreciate today in Medicare, super, and just wider spread banking access for people. And so along came these what they call friendly societies, and people became members of these organisations, and they would basically contribute money into what became expanding pools of wealth or money, and then people could receive benefits when they needed it. And these things were started by churches, trade and industry groups, local communities. I went digging around for some of the names of the ones that people would be familiar with, and the early iterations were like Manchester Unity, not the football club, not United, for any football fans out there. IWF, which is the Independent Order of Odd Fellows. A lot of people don't know what IWF stands for, but it's Independent Order of Odd Fellows. So think robes, horned hats, and secret handshakes sort of stuff. Yeah. AMP, MLC, Colonial, and Prudential in their early iterations were all part of this kind of group that were producing these products. And in fact, into the 1990s, those are all names that people would be familiar with. 4 or 5 of those dominated this landscape, again, before super came along in the 90s.
Absolutely. And so they were essentially community-owned from 100 years ago.
Yeah, exactly. Yeah. So I think IWF started in 1846. They were absolutely member orientated, very much community orientated enterprises. And they had two core characteristics, and that was protect the person if they died and give them savings if they survived. That was kind of their motto. So they were super popular as a way for people to, as I said, access these much needed either welfare benefits or some kind of insurance sort of aspect. And so it became very much what they called a bundled or hybrid product, where there was within this scheme a bit of insurance and a bit of investment sort of bundled together. People paid a single amount into it as a premium, and away you went. And yeah, they actually, for the purposes they were built, were extremely popular and very much purpose built in doing what they were designed to do.
And so, Jarrad, this was when I first started the AMP whole of life policy. Was that theoretical best of both worlds, that it carried a $1 million life insurance policy, but if you ended up surviving and then getting to say 60 and wanting to cancel the policy, you almost got a compensation prize or a second prize in getting some capital back at the end of the day.
100%. Yeah. There were little nuances between how they would operate, because they started to play around with some of the internal mechanisms about what you got when, how much the insurance. Some of them were over time reducing insurance and a bigger savings balance. So the balance of the internal premium as it continued to age and the longer it went, sometimes that created internal adjustments that again were built in. But yeah, they were literally this weird blend of the two sort of elements, this insurance aspect and this sort of savings element. Yeah.
Absolutely. And so KeyInvest today is maybe not the last, but one of the last that's still around in terms of, as of today, still a friendly society.
Correct. Yep. Yeah, 100%. So it's in rare air. It's not flippant to say it's in a very quite selective club of companies that have managed to survive, looking somewhat like it used to look like in the late 1800s when it effectively spun out of the national IWF scheme, which became a listed company and had to change its name. And the big shift, I think, in the market was really around just but obviously 1992 when superannuation and Keating came into play, superannuation guarantee kicked off. And that was primarily because it took over that savings element, that long-term wealth generation aspect of the product, and left it a little bit redundant from that point of view. So we saw a big shift in the market. These were very dominant through sort of the 1940s through to the 1990s. But then we saw a massive shift in the market.
And so now obviously we've got this question of today's products in learning a little bit about that past. Is it an investment bond or is it insurance bond that we're talking about today?
Yeah. So I think it's fair to say that the shift meant that the hybrid element caused both of those two different streams to be considered to be necessary to split apart. And there was a few different reasons for that. There was some poor returns and poor performance. People wanted more transparency and more flexibility about the investment side of it. But people wanted to sometimes also adjust the insurance element part of it. And it was very rigid. It was all happening internally. There was no transparency about where the premium was going in terms of what it was funding on the investment side versus the insurance side. Along with super kind of dominating the market going forwards, it made sense for the market as well to say, we really want, as a client, we want transparency around what we're funding, but we also want that flexibility. And so it made sense for them to split apart. And in their current iteration, what we saw is that the MLCs of the world became bona fide retail insurance houses, and the friendly societies effectively gave away that element and still maintained the investment element of it. And then pivoted a little bit to start to look at some other ways that could operate. So funeral bonds suddenly came about. Education bonds were built off of maintaining some of the characteristics of a bond, which we'll no doubt touch on. But I think it's fair to say that if we have to call it the battle of the two, that really, even though the language sometimes gets a bit confused still, they really are investment bonds now. They're not insurance bonds because there is really no insurance element to them anymore. No,
besides the rule, and where I get confused as well is the rule book sits within the Insurance Act, I suppose, in the Life Insurance Act. But at the end of the day, there's no There's a beneficiary, there's a life insured, but at the end of the day, what your return is simply a function of how much money you put in and what it's invested in.
Yeah.
Yep.
And this is the funny thing about them, and it's where some of the myths operate from, is that that's the really unique element about them, is that they, 100% were correct. They administered under the Life Insurance Act, and that's where sort of some of these really unique and interesting characteristics are actually written into the legislation, if not the fund rules of the providers that are left. And coming back to your early point, there's only, I think, 4 or 5 that are considered still member-based friendly societies left in the market. So it became a shrinking pool again after super came in. A lot of friendly societies or mutuals didn't survive. They weren't able to pivot quick enough to the changing landscape in terms of consumer demand and the shift in focus to super. But there was also a lot of mergers and acquisitions. So a lot of friendlies merged with one another to get scale, to look at ways they could pivot their product. And that led to education bonds, funeral bonds, and so forth. But that is the interesting thing about them, is that they are still very much heavily connected to that insurance element, but your return is your investment. So it's still a bit of a weird hybrid.
Yeah, absolutely. And that's the challenge for you in this distribution role that you have, is that although these products have been around for a long period of time, they've had some changes, which we'll go through, but also the understanding of them is really low, because I would say predominantly that the other structures were just somewhat better as the rules around superannuation have changed, barring last year's changes. But as tax-free superannuation changed, it became that a bond for a 55-year-old or a superannuation for a 55-year-old, it became that these other structures ended up being slightly better. And the understanding or the rules may have been a little bit easier as well. So let's do Mythbusters. I'll give you a few, and then you've got a few written down as well. But the very first investment bond I ever looked at, the total fee, all up fee and things like that, was about 2.5% per annum. How are we tracking today versus what the assumption might be of an advisor that looked at them a long period of time ago?
Yeah, it's a good one to start with. I think, like a lot of things in the industry, there's been a lot of rationalization, but also a lot of efficiency gains. And that's meant that whether it's product, whether it's a platform, or us, which is a bit of a hybrid of product and platform, is that we've seen the cost to administer them. And obviously it's a competitive landscape. Generally, MERs and fees, administration fees, have ratcheted down, and investment bonds and funeral bonds are no different. We are one of the, I think, probably the best value. We're 30 basis points. So for those uninitiated, it's 0.30% on what we hold under management as an admin fee. And so that's extremely low. It's not platform low, but again, we're also a product. It comes with a little bit of extra cost than just an administration platform. But it's significantly lower than what it used to be. And people do tell me they remember it being 75 basis points or even over 1% at some stages, just to pay for the product. And then you had your investment on top. So
investments used to be expensive as well back in the day.
Yeah, and people do recall. So we've been beneficiaries in the sort of evolution in the investment space as well. You can pick up ETF type products, which are on our investment menu as they are on most investment bonds, for around the same as our admin fee. So you're looking for all up 0.6 in a product which carries some quite unique benefits. That's pretty good.
Absolutely. So that's myth number one that I still come across in talking to advisors. Myth number two is just the complexity around you can't get your money back. This idea that it's Hotel California, that you put $1 in and you can't get it back for 10 years. Let's bust that myth.
Yeah, our running joke with this is that, all of these busted myths are on page 42 of the old DFP3 module.
Yeah.
That everyone skipped past pretty quickly because, if you'd done your DFP in the last 15 years, where investment bonds weren't really the sexiest of the products you probably were keen to learn about. But I'm not even sure if it was in the final of the advisory exam for DFP8. But
probably not.
Anyway, we digress. But I think it's a confluence around, and what I tend to find is it's a confluence of misinformation around sort of long-term non-commutable income streams and God bless us, the investment bond 10-year tax-paid status. So I sort of at length tell advisors these are 100% liquid. You have uncapped contributions in the first year, and you can access that capital and the money in them whenever you like. All you need to really be mindful of is what happens and what takes place from a tax perspective. So anywhere up to the 8th year, whatever you take out is fully assessable, has a fully assessable income element to it. It reduces and ratchets down as you get into the 9th and 10th year. So 2/3 is assessable in the 9th year, 10th year, it's 1/3. And then all you end up with after 10 years is what they call a tax-paid bond. And once you reach that status, it stays in place for however long you hold that bond. But it just means after 10 years, you can take all the money out and it's tax paid. And all that means is take all the money out. I've paid my tax. I don't have to pay any more. I don't have to report it to the ATO for assessment for any income tax. It's tax paid. So it's fully liquid. And as I said, people just get confused behind or around that element of, I've got to hold it for the 10 years. If I don't, then I'm losing. It's not the case. It just changes the tax sort of element of it.
Absolutely. And I accidentally called it a franking credit once and made the mistake, but there's a tax credit, not a franking credit, but a bit of a tax rebate as well if you do withdraw it early, which I always say you're not paying any more tax than if you had invested it in your personal name. So you are deferring tax for a period of time because it's within the structure. And if your situation changes, there is this element of liquidity. And sometimes it might be beneficial to make a withdrawal. If you're off work for 12 months and you have no other assessable income, then it's actually potentially in a client's interest that they might make a withdrawal and not pay a lot of tax, even though there's capital coming out. But obviously the story is all about accumulating wealth because that's how the structure perhaps was invented many, many years ago. Do you know where the 125% came from? Like, where's the idea behind that?
Yeah. So, and I've asked the question myself because I was quite curious about whether or not that was something the industry kind of came up with, or whether it was legislated. And I think it was legislated in the Life Act as a way to just mitigate higher income earners being able to dump a whole heap of money in the 9th year and achieve a tax paid status on the money. So it was designed that way to encourage people to make regular contributions as opposed to what they thought might be a sort of a back-ended, lump sum contribution to get this tax paid status a little sneakily. So it was just written into the conditions around, well, if you're going to get this tax paid status and we maintain it, and we just need to make sure that you can contribute what you want in the first year. There's no cap, unlike super. Again, another little sort of myth. And then you have up to 125% each year that you can contribute of the previous year's contributions.
It ends up being a lot of money. If you started with $100,000 of your capital going in on year one, as you compound the 25%, if you put 125,000 in year two and then whatever it is in year three, the number gets really big in the back end that I don't think many people are running into the issue that they have more capital that they'd like to put in, and you can just start another bond.
Yeah, 100% right. Yeah, and coming back to your earlier point about the withdrawal, it is one of our case studies that we do talk to, but just again to highlight that sort of uniqueness of the tax credit, and I'll touch on how that actually works, because again I get that question from advisors and as well about how the tax credit comes out. But yeah, it's one of those unique sort of elements to the product that we certainly see the smaller investments and the regular savings plans really utilize quite well that 125, or it tends to be that bigger lump sum where there's maybe some estate planning aspects to it, but it compounds into a really big number. And I think one of the things that's attractive about it is the fact that there is this sort of quite exponentially growing. If you continue to use up the 125 rule, as you said, that continues to compound because 125 is on the previous year's 125. And so you do get this accumulatively growing element of where you can contribute to your money into a tax sort of friendly environment, and you're not subject to these restrictive caps like super. And that's becoming appealing to people now, given, I guess, caps have stayed in place for super. But there's access to the money, and that's becoming something that's quite real to people as well. They will continue to contribute to super. It's a very tax-friendly environment, but I think this element of it is genuinely locked away until you to satisfy a condition of release is something that people are going, maybe having some to the side that sort of is doing something similar. It's got these longer-term tailwinds behind it from a structure and tax point of view, and I can be in the market and invested. But the ability to tap into it and pull little elements out if I need to, if there's an emergency, if there's something aspirational that I want to do and I've got the ability to tap into it, it's quite compelling.
Yeah, absolutely. So talk us through as simply as you can, but talk to financial advisors where a client at year 5 has to withdraw $100,000 of their bond. How would you explain the income and capital and credits of that withdrawal?
Yeah, so it's important. We don't retain TFNs or anything like that for clients. So it's a self-reporting mechanism. But if it's say year 5, then you're obviously underneath that 10-year tax paid period. So there'd be an assessable amount and it'd be wholly assessable. What you would do is we give you some instructions on where you just need to enter that amount into the tax return. There is a specific field. And if you're getting an accountant to help you or the advisor's working with an accountant, they will know typically the field that the amount needs to be entered into. Yep. And then when it hits the ATO's desk, they just know based on the code that money's sitting in to apply a full 30% tax credit. So you can get a little bit of arbitrage, as you said, if you've gone from full-time to part-time work and your tax rate's dropped from over 30 to under, you obviously get a positive offsetting and credit.
So the money that you withdraw, I may not get the ATO language right, but it's essentially tax paid up to 30 cents in the dollar. So if you were on that marginal tax rate, you may not pay any additional tax.
Correct. Yeah, 100%.
Yep. Yeah. Obviously, if you're lower than that, you might get a tax, not a refund, but you might get a tax offset.
Correct.
Yep. Okay. Yeah. Which is a good lesson for people just in terms of these myth-busting things, is that actually there may be strategies that you implement with clients in terms of who owns the bond. Because there may be times in which you can see a strategy for a client where you can withdraw partly, and a part withdrawal doesn't reset the 10 years?
Yeah, it does. Yeah. Okay. So if you're pulling money out, then typically you've got to restart.
Okay, understood. What's another myth on your side that advisors bring you?
Yeah, typically if they haven't looked at them for a while, cost is a major one. That 10-year is definitely a classic that's there. It's also investment options. So I think a lot of them started out, they would have had 4 or 5 multi-managers in there and probably not much rigor around are they good long-term top quartile performers. That might have been the intent, but very restrictive in terms of advisors started to get really quite savvy in particular about building portfolios and the managers of managers, if you like, and getting close to the individual managers and forming relationships. And that's obviously very hard to talk to a client about in money you're managing outside of these environments. And then a strategy says this is a good thing, but suddenly you've got to try and talk them through a very different strategy, which is a manager of managers approach inside, say, a bond. And so what we've seen is quite a big expansion of the menus that sit inside these things. You know, costs have come down, but also the investment menus have expanded massively. I think we're at 2 investment options, and we are on an exciting path at the moment of expanding that outwards to sort of 95 options. And so that starts to give advisors the ability to really play both ends of the spectrum, really simple with maybe smaller amounts where a multi makes sense. The grandparent who's putting some money in for a grandchild to try to let that money and that pot of money compound over time for deposit for a home or whatever it might be. We're seeing that a lot. Those larger amounts where the advisor really wants to get into replicating almost their SMA or getting quite active in looking at the managers and building out a portfolio or doing that core satellite approach.
Understood. And one of the other quirks, and I honestly don't know the answer to this, and you've not been prepared. I've not prepared you for this question, but when you look at the performance of the underlying investments, like if I look at your performance report and go, oh, I wonder what the investments have performed. The performance is after tax inside the structure, and so it creates this difference between what a fund manager is reporting and what you're reporting as the return. Why differential? Why are you telling us after tax returns?
Yeah, so it points to the uniqueness of the structure. So I like to actually refer to it as an investment menu with a tax wrapper around the outside, otherwise called an investment bond. But that's effectively what it is. So we're a custodian of the funds. We have a corporate element to that wrapper, if you like, that tax wrapper. And so we operate very much like a company. So when those returns come in, we do a whole heap of internal accounting for that particular fund, which might include a whole heap of depreciation, foreign income tax offsets, franking credits, as you mentioned a bit earlier, which is obviously atypical of Australian equities investments. And so the effective rate of tax is quite nuanced between all the different managers, depending on the derivative of the income and gains that fund might have. And so effective rates of tax can actually range from sub 1%, which is one of the funds, all the way up to virtually 30%, which is the maximum tax paid at a corporate rate. There's quite a range, which is explanatory of the difference in the business model of all.
And maybe a little bit like super, because super, if you were to look at an industry super fund, they're quoting their unit price and performance after paying or adjusting for tax. Maybe it's not perfect, but it's definitely talking about that as well. Whereas if I looked at one of your underlying managers, just choose Vanguard for the moment, like Vanguard might say they got 14% and you're saying you got 10, and the difference is the tax. There's no difference in the underlying investments, but it's at the end of the day, you're quoting after-tax returns, and after-tax returns is what actually people can compound and grow over time.
Yeah, 100%. Yeah, so there's actually no difference. We track exactly what our investment managers are doing. We don't intervene or have any mandates or mirror funds or do anything like that. We just keep it nice and simple and effectively just apply, as I said, that tax wrapper, that corporate tax wrapper around the investment managers and what they do.
Excellent. So let's change from myth to strategy. We've got two big changes, obviously, that we may talk about. We'll talk about the super changes at the moment and what you're talking to advisors about and what advisors should be thinking about when it comes to accumulating too much in super or having to potentially even withdraw some money from superannuation. And then secondly, we'll jump into sort of some of the new tax changes that are coming down the line and what we need to think about that. Hit me with the super one first.
Yeah, the Div 296 in particular, and 293 was the start of this. 296 just took it another step further. But that's obviously been watered down from the original changes. And remember, they were talking about taxing unrealised gains, which I was just chatting with a chartered accountant the other day, and I think there's still a lot of rolling of eyeballs around the fact they even considered that. But
I'd like to just say that Australian super essentially taxes, or all industry super funds, I put them all in one bucket, they all tax unrealised gains if you want to leave the fund.
Right, there you go.
Think about it, because all their unit prices are on a post-tax basis, including assets that they haven't yet sold. And so everyone was in an uproar that this is the first time it's happened. And I'm sitting here going, investors that are in industry super funds are already in that category.
Yeah.
Slight digression, but taxing unrealized gains is dangerous when you think about the individual assets that you may own. But when you're pooled, you're already inheriting other tax consequences with pooled investors.
Yes, yeah, you're 100% right. And I think as a chartered accountant, these sorts of people are mostly thinking about their clients that have got large farming assets sitting in moved into a self-managed super fund, and it's a nuanced area, but it's very ugly when you start bringing things like that, which typically do have to speak to the whole industry. It wasn't just something they announced for industry funds who are already doing it. Going, well, doesn't impact what we're doing because we're pooled fund entities. Look, there was a couple of things that then happened. I think it started to create more conversation around what I like to call regulatory or legislative risk, right? It started to become a new thing that advisors to their clients and even clients themselves, because people are more savvy than ever and they can do their research, was that there's just this element of risk that the government can change the rules. I've got all of my money invested in this sort of structure. Is that the best place to have all of my future wealth pooled together in something where the government, as we've seen, could turn around and say, now there's a tax that we're going to impost on that? And it's a $4.1 trillion pool of money. So anyone that thought that eventually there wasn't going to be a wind back of some of the very generous tax sort of arrangements that have been in place, that they're kidding themselves, because we've been very much seduced by the superannuation being the centre of advice, and maybe quite rightly, make hay while the sun shines. But I think that a little bit of this is an unwinding of that as a core focus.
Yep.
And 296 is something that really did start to create some question marks that we were trying to answer. And so actually, quite interesting, we can talk to the fact that we've been involved with super concepts as a way to tap in from a technical point of view, to even look at pension funds, if they've got some liquidity, to actually place some money into a bond. Because they're what's called a non-distributing entity, they don't actually then pump that money into, I guess, the profit and loss of the superannuation fund from an income point of view.
Yep.
And then that being a way that a self-managed super fund could reduce the 296 tax that actually would need to be paid. And so we're doing a bit of technical work around that. It's still a work in progress, but it got us starting to think, as I think it did advisors, thinking about where bonds can play a part as part of that hierarchy of all the different tax structures. And we are one as individuals. We have a tax structure. There's companies, there's trusts, and there's super, and there's us. And I think we have now more of a permanent fixture in that hierarchy as an option or something that clients could and should consider.
Absolutely. And the larger ones may be considering taking some money out of superannuation. Why pay 30% tax guaranteed in superannuation? You may find that you're paying less tax outside of superannuation. It's all theoretical, those ones, because you can't know what future returns will be. But obviously the potential death benefits tax as well is one of those ones that you know that you're avoiding by making the lump sum capital withdrawals from superannuation as well, which I think combined with these other benefits is a great story for you advisors to be thinking about with their clients.
Yeah, absolutely. And it's not a cure-all. As I said before, every single individual client needs to consider it on its merits, and with their advisor, just have a look at how the numbers play out. Clients that have got a significant superannuation assets and are affected, we know it's a small subset at the top of the pyramid. But if they're in pension phase, or they've got some accumulation and pension and assets inside a self-managed super fund, then it's a little bit easier. It's about reducing the total balance, and they can make tax-free withdrawals. For someone in accumulation, it's a little harder. And liquidity is a key thing, right? If they've got a big industrial warehouse or commercial property, they've got a liquidity issue anyway. It's not just a 296 issue. It's what happens if I move into pension phase or I get disabled, and funds need to turn over in that. But certainly if there's some liquidity, then in pension phase, it might be a good receptor from an estate planning point of view. If it's an accumulation phase, as I said, we think there could be some merit in some of the money moved across into a bond, actually alleviating some of that 296 tax. So from a super angle, that's what we're seeing a lot of, is looking at where that can be optimized for those clients where they have got an immediate 296 issue, or they may expect to have one in the coming years.
Absolutely. And then some on the new tax changes that we're facing. I've been talking to advisors about whether the idea of people investing in a family trust, that as an investment vehicle, that made sense for a few years, and the corporate beneficiary theoretically made sense for a few years, especially if it was large sums of money. But perhaps now a tax paid at a maximum of 30% investment bond is simpler for clients' lives.
Yeah, 100%. And you and I have probably ventured down the path of having to look at how our own businesses or enterprises are structured. And all the people that might watch this, if they're financial planners, are asking the same question of themselves in their own situation, which is, you probably set up a family trust, and you've probably got a trading entity and maybe a holding company and some other things like going on. But distributions from trusts with that 30% tax, if that continues to stay as is, I think that's the biggest game changer in the budget changes the government announced, because they turn trusts from being a money distribution tool into a tax-paying entity. That's a massive thing. And again, if I just refer to conversations I'm having and what some of the question marks around what's going on for advisors are about, is an advisor said to me, so just let me wash through the idea of, would a trust own a bond? Does that help anything? I said, well, no, because it creates the same double taxation that everyone's raging about, which is, as that corporate tax wrapper, we are going to, even at best, if you pay, or worst, I should say, if you're paying 5% because you're in an investment option that they've got offsets and depreciations and whatnot that they can apply, and we can get the effective tax rate down to 5%. You still, when you want to pull that money out, it goes into the hands of the trust and distributed, you pay that flat 30%. And it really, that one change has really changed the use of trusts to do those sorts of things where you might have done that in the past. I think if it stays as it is, it doesn't make much sense anymore.
Absolutely.
So then, as you said, direct ownership makes more sense.
Direct ownership seems to make more sense to me when I think about it. And to go back to one of the unique features that I understand of bonds as well is that you can move the owner of the policy from the trust to the individual without any tax implications.
Yeah, and if we go back into sort of the myth busting, it just reminded me of one that I thought, which is, it came up the other day. You can move between the investment options and you don't pay any capital gains tax. And again, the advisor of the day didn't know. It's just the buy-sell spread. You can go from really aggressive into a conservative income fund and you don't pay CGT for making that switch inside of our structure. The other one that's also not well understood is the sort of the ownership arbitrage that you can do. So we have a key planner. Many of the other providers have another word or term for it, but it's this unique thing where you can actually assign the transfer of ownership without paying stamps or any tax implications, but carry through all of the tax benefits that you get.
Including the 10, like the sub 10 years, or if you're after 10 years.
Yeah. So as an example, I assign that I want my $100,000 bond to go to you, Dean, on your 25th birthday or your 30th birthday. I can make that assignment, and even if I predecease that vesting date, somebody else will manage it, usually the estate, executor of my estate. But it basically, when that event is triggered, you effectively, as the life insured, are transferred ownership. It doesn't come out of the bond. It literally just flips from my name to yours. And if that's been longer than 10 years, instantly you have a tax-paid bond in your name that you can pull money out if you want, no tax impost, and then no CGT on that vesting. So that's also not well known, but again, is a unique feature.
Absolutely. And I think that this is where the advisors that are getting involved with somewhat complex estate planning needs with clients, which clients that have multiple families, like they've separated and had 2 families or more than 2 families, we move into complexity of estate planning as a result. And sometimes these structures are actually quite a good tool to manage estate planning because they're outside of the will and you're dealing with a third party, which is you've got almost no choice but to follow the rules, which is whoever the beneficiary and recipient of that bond is upon death.
Yeah, 100%. Yeah. And look, I think one of the things that these instruments can do is actually enhance the relationship with clients for advisors, because one advisor said, look, if I really understand key planner elements really well, what it requires of us is to actually have those deeper conversations and ask those next 3, 4, and 5 questions that we might otherwise skip past, because that actually influences what we might do with some of the features of the product that you can utilize. The key planner element, it can operate effectively like a testamentary trust. It really does facilitate sitting with a client saying, if you've got a grandchild and you want to support them in later life, but that grandchild has mental health issues, if they might have some sort of addiction issue, giving that person a lump sum of money can be a bit fraught with danger. What they like is that they can still pass on those funds, but with instructions around how that money is accessed and so forth. And so it leads advisors down this really deep conversation with the clients they might otherwise just skirt over. That's really quite engaging, but really speaks to the power of what you can do from a future estate point of view in these things.
Indeed. And the other advantage is that you're already building and creating the investment strategies for that future as well. Like if you're waiting for the testamentary trust to do some of the estate planning work, you miss it. You're not yet investing the capital as if it's for the next generation. Whereas if you agree with the client that this money's going into this structure today for when little Johnny's 30, you can have a much different investment strategy for that bond as a result, because you've separated the capital and you can allow it potentially to be in a higher growth bucket because it's got a much longer time frame.
And we know estates are coming under greater and greater contestability. It's an interesting nuance, but again, under the Life Insurance Act, investment bonds are a non-state asset akin to super. Only in New South Wales do they have this concept of a notional estate, which allows, when they're making sort of financial determinations from a court perspective, allow them to look at things like these assets. But they're the only state, and I understand that is a limited window that they are able to do that. So it's quite restricted. But we know organisations like the RSPCA, which get bequeathed money all the time through estates, they get bequeathed, large sums of money, or it's a large sum of money from lots of people. But the issue they face is that sometimes they can be waiting just like everyone else, because there'll be, someone will contest the will. And so it sits, in that state for some time until, that's all washed through the system and probate's, issued. Again, the ability to surgically and very deliberately use something like a bond to bypass the estate and get money in the hands of people that you want to directly have that is quite attractive when you're having that, deeper estate planning conversation.
Absolutely. Mate, we've got to the end of our time. We've actually probably gone over time, which is, for those that are still listening, thank you. Thank you for continuing. Obviously, if you're still here, you've got some value out of it, most definitely. But Jarrad, thanks very much for coming and sharing some of your knowledge of investment bonds, as we're calling them today. Definitely appreciate you coming on board. You can see Kamanis, and we can share this with him in due course, most definitely. And thanks to the listeners. If you've got any questions, you'll see Jarrad's name on LinkedIn. You can reach out to him directly, and stay tuned for the next episode. Until then, we'll see you next time. Cheers.
Thanks a lot for having me on, and see you next time.
You're welcome.